I think we're looking at a 21st century economy through a 19th century lens. You know what I'm saying?
Or you could even say, post-COVID through a pre-COVID lens. I mean, because
Yeah.
kind of everything changed.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots. And I am joined as always, and I'm not going to forget to turn off this mic camera anyway. I'm joined as always by the brain trust himself, Mr. Chase Taylor. And what do we got today? Several different ways we could attack today.
Well, we could do a little Fed pregame show.
Yeah. Well, and I still have my spidey sense. I don't like the look of things. I just don't like it. I think we were saying similar things yesterday. I don't like these last 2 weeks in September. Seasonality's nasty. I don't like the way the VIX is behaving. Picked up some vol today just in case. Trimmed some positions. What did we get for anything data before we get into the Fed? Any data? What did we see today?
Yes. So actually a good bit of data, the most important being retail sales, which came in like very strong. It was a very solid retail sales print. So data continues to be very much a mixed message. Like some of it's good, some of it's bad. None of it's super bad. None of it's super good. It's making their job very hard. You got home builder sentiment came out basically unchanged, still at horrific levels. Kind of surprising given what rates, have done here lately. Even, mortgage applications, they're not good, but they're like the best in like 3 or 4 years. Mm-hmm. So I would have thought maybe home builders got a little more, excited about the way things are going, but that did not happen. So far this week, you had Empire Manufacturing yesterday came out. That thing's very volatile. It moves all over the place, kind of silly, but it was really, really bad. So you couldn't get more mixed messages from data than you have in the last, couple months, I think.
Well, we were talking about this internally. I don't think we talked about it on the show. It's interesting to me that we have seen this has been the market run and the market. The market has changed substantively over the last 15 years. And you can tell that by, you and I talked about how many rules it broke, right? Like, yield curve.
Right.
And, there's so many of those rules.
Tying to the ISM.
Yeah. That have just been nuked. And it's been turned. And I think that the age of central banks has played a role in that. I also think the age of central banks coinciding with passive investing has played a big role in that. But it's a substantially different market. And one of the impacts you and I talked about, I think what we're doing, and I think one of the reasons that the data is so volatile and has been so misleading at every turn and, just all that, I think we're looking at a 21st century economy through a 19th century lens. You know what I'm saying?
Or you could even say, post-COVID through a pre-COVID lens.
Yeah.
Kind of everything changed.
Yeah. And I would expect the data to be very inconclusive going forward. And I would expect us to, whether we're talking about accelerations in the economy or recessions, right? I would expect it to kind of come out of the blue. And I think there's so many different things playing into it. But, one of the things I think playing into it is also the internet and the information age. And, there's so many things that have changed about the way that people go about a day of work, right? And it's so easy to gloss over those things. But when you think back, right, you think about how many of these growth metrics, literally, a lot of these growth metrics were developed 100, 150, 200 years ago. right? Think of how different the economy looked. Think how different it took a letter to get across the. You know what I mean? So to not acknowledge the interchange and the interplay that would have on human behavior, the impacts it would have on human behavior. Human beings make up an economy. I cannot help but to think one of the biggest drivers of this data being quote unquote so all over the place, so unreliable, is that there's been so much change that it doesn't work like it used to.
Yeah, and you have very significant push-pull factors too. I mean, it's almost like a cold front hitting a giant high-pressure system. Like you're gonna have some storms. Like you have things that are really dragging on the economy, like tariffs, and then you have a 7% deficit that's really boosting the economy. Like you have this huge AI capex boom, really pushing stuff, and then you have manufacturers and construction people letting workers go. Like it is really significant as far as the cross currents go. The only other data today was the New York Fed Services survey, and that thing was brutal. So New York apparently struggling, judging by Empire Manufacturing and then the New York Fed Services, but the Northeast, I should say.
But like you mentioned, man, that's another thing I've noticed. I wouldn't be at all surprised by the time that data reading comes out again.
Yeah, positive 10,
rip higher,
19 or something.
Yeah,
right.
Rip higher. I mean, it has been all over the place. So many of these data points, and like you said, again, not at all the first guy or the first 100th guy to bring this up, but I just think I think this is what fourth turnings look like.
Yeah. Well, one thing I definitely want to cover that, because I'll forget, is net issuance of equity. Simon White writes a column from Bloomberg, and he had this chart in there, and I can't recreate it, which is frustrating me, but basically showing net equity issuance. Think of buybacks, IPOs, stuff, just literally the supply and demand of just equity for years and years and years now. That has been deeply negative, which has been a huge boost to the equity market, especially from the buyback side, because it's doing most of the work.
Yeah, no, and a simple way to understand that if you're at home is so they're putting less paper on the streets. Money supply continues to grow over time, and the same dollar, more dollars are chasing less stocks.
There's a lot of hippos going after one ball left on the hungry hippo thing. But the point here, though, is like it's actually getting close to going net positive. It is like really moved the other direction, and you can kind of tie the AI capex story into this. Like obviously free cash flow and buybacks, big correlation, right? If you're not making money, you're probably not gonna do a bunch of buybacks. Now, if rates are zero, maybe you borrow to do it or whatever. But so as these companies, you think like Meta, who all of a sudden is borrowing money to do capex, like, are they going to keep doing a bunch of buybacks? Maybe not, right? So we may end up in this situation where you go net positive, especially right now where the IPO window is open. And you can see very clear on a chart, like anytime you go positive, the equity market does not appreciate having a positive net issuance. So just like a small kind of low key thing to think about. Well, I shouldn't say small or low key, actually. It's kind of a really important thing that not too many people think about, I don't think. That's very much worth monitoring moving forward, especially as long as we have IPOs running their way through and AI capex going, just through the roof. Yeah.
Yeah, it's
I mean, to rip through the markets since we're
yeah,
closed?
no, I was just going to go on another diatribe, but just how complicated every time I sit there and I'm like, oh, there's another factor. Oh, I wonder and then I'm like, oh, there's 8 more. Oh, there's 10 more. You know what I mean? Where you're just sitting there going, and that's why in a period of time like this, I think that you have to focus on values and fundamentals and the big themes. Right. And in my opinion, the biggest themes are currencies, currency degradation, debt issuance, right? Like, what is the consistent thing? I think from a U.S. perspective, out of control government spending, right? I think that's a consistent thing. I think a weaker dollar via out of control government spending, people repatriating capital, all the things we've talked about. And I kind of think that's the only, and as far as I'm concerned, again, stay diversified and don't all load up
Sure.
on one thing. But I just don't know if there's anything else out there that I see that I have a great deal of faith in,
Right. And to your point, like if you just look at the S&P chart, it looks like it's going straight up. But priced in euros, the S&P is still negative on the year. Whereas if you price European stocks in dollars, they're up almost 30%. Like we are so used to being able to ignore that. Now all of a sudden it is a, just gargantuan deal. Like, if you're overseas and you're investing here, unless you're in some tragic currency, like you which is hard to find this year. Like almost everything is up against the dollar this year. So you're losing. Like you're so much better off being in your domestic market this year.
I'm really surprised that I mean, maybe it's not fair to call it a trickle, but the flow of money into foreign equities, I'm a bit surprised it hasn't been more intense.
Right. And it hasn't. Yeah. Like even, you can look at a chart of Chinese equities and they're up, 40, 50% this year. It's going kind of straight up at this point. But if you go look at the flow data, like, yeah, it's picked up and it's decent, but it's not what you would think.
No, I just think again, talk about behavioral finance, right? We have never, the average bull market in the United States, average economic growth cycles at average 6.5 years, right? That this last one that we're technically still in it because we haven't had a real recession, right? It's been 15 years. And so over that time, we're virtually the only major economy that hasn't had a recession, a proper one anyway. And I think that that's a feature of this market. And I think people like poo-poo this, and that's fine. But like you and I have said 100 times, and this market has shown us 100 times, it will walk right into things that are seemingly obvious and completely unaware. And I think I kind of think that's part of that going on now. And I think it's just been driven by those last 15 years is a really long time.
You can develop a lot of bad habits in
a
decade and a half.
And what was the one thing, if you wanted to rock and roll and beat, there's only one thing you had to do: buy the dip in American tech. That was it for 15 years, right? And you and I have always seen that, we all know the examples. This is what always happens, right? Like you get this trend or you get this trade that everybody in the world jumps on and eventually it peaks. And I'm not saying those companies all need to fall there. I'm just saying, I'm just surprised that more global investors aren't looking around and looking at the delta between the valuations and just going,
I hope it stays that way.
Yeah, no, I do too. Because boy, it sure is nice to keep finding these gems.
So a good example of this is I saw someone posted about, like, here's a stock that is the cheapest it's been in 5 years, and it was like the McCormick company that makes spices, right?
Yeah.
It trades at 20 times earnings.
No
but
way.
It's the cheapest it's been in 5 years. And I'm just like, God, like that is so unappealing to buy a staple at 20 times earnings when I can go buy, a growth company overseas for 10 times earnings. Like that, this is wild.
And you get McDonald's for 28.
Pass.
Yeah, I know. And that's the thing. Everybody's like, oh, it doesn't matter. And I'm like, guys, at a certain point it does, right?
Right.
The valuation spreads if you want to ignore those kinds of cash flows, and if you want to own a company that's US based at 28 times earnings, and you don't understand what a 6.5% dividend at a company growing double digits and trading at 6 times earnings, like now again, it's not every time, right? Not 100% of the time, but if we look at those kinds of stocks just separately, okay, over time, it is virtually impossible for that cheaper stock to not win, right? When the spread is that big, I'm not talking like 14 times earnings compared to 25. When you're talking about solid companies, assuming you've done your work and they're good companies, just on a cash flow basis, right? I mean, think about you're reinvesting that dividend every year, right? There's an automatic 6.5%, 7% growth baked in, right? Things that can go well, i.e., they're going to buy back stock. There's just so many different ways to move the needle. And I understand why people are hesitant to do it. I personally look at it and I go, I think I absolutely am convinced you've missed the dinner bell. Meaning those deltas get so wide. And if you've got any impetus for people to pull money back to their home country, obviously it's worked great this year. No guarantee it keeps working. But I mean, to keep throwing money into U.S. equities at the same pace you've been, you have to be, that is an acknowledgement or a statement that you do not believe fundamentals matter. And I just think, do they matter as much as they used to? No, not especially not in the short term. But when the delta gets that wide, it absolutely does matter. I just don't think there's anywhere. I don't think there's anywhere else to be putting money right now.
Yeah, totally agree.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
You want to hit the markets?
Yeah, let's do it. Yeah, give us the rundown.
Not too juicy today, but S&P was down 0.13, Q's down 0.08, small caps down almost 0.5%, equal weight down about 0.3, Mag 7 up 0.4. All world ex-US was up 0.03, so it did beat the S&P, but I mean the dollar was down almost like about 0.7. So given the dollar's brutal day, kind of surprising the rest of the world didn't do a little better. Oil up 2%, you're above 64.50 now. Bitcoin up over 1, gold pretty flat, silver pretty flat. Gold miners down 2%. The 2-year yield was down 3. The 10-year yield was down 1 basis point. And then we had another day of people, getting some hedges on before tomorrow because vol was up another like 1.7% on a day where market was basically flat.
Yeah. So now we'll pivot to that Fed conversation we're happening because I mean I don't know. I would assume nothing more important would get announced this week. At the same time, I'm perplexed at every Fed meeting why everybody's like, it's like you're watching for a new pope to get elected. It's like, is it white smoke coming out? You're like, guys, just look at the bloody market, right? Like, what is it? One time in the last 20 years, the Fed made a rate move that wasn't priced in, right? So what are they going to do tomorrow? I'll tell you what they're going to do tomorrow. They're going to cut 25 basis points, right? And if they weren't going to do that, they would be out. They would have been out over the last week, speaking nonstop, trying to get that price to move in the market because they don't want surprises.
Right.
Now, I actually believe that makes the market more fragile.
Yeah. And we had the couple folks last time, voting against the policy, having some dissents. I was talking to someone about this a minute ago. Like, I could see a situation where you actually have someone dissenting because they wanted 50 basis point cut, and then someone dissenting because they wanted no cut. Right. Which would be just, I don't know if that's ever happened, but I would almost be surprised if that didn't happen this time.
Now this is, I've been asked about this on several different interviews over the past week. And my answer has been, I think that you have enough data to where if you feel strongly one way or the other, you can make a mildly compelling case to do either or.
That's the crazy thing is, like, I feel like you can make the case for the 25, the 50, and the nothing.
Yeah.
So like they could all make a coherent case that has like a flip side for sure, obviously, but like.
Now, isn't Fed and when I say Fed policy, there could be a delta and a difference between stated Fed policy and the way they actually conduct things. But isn't that kind of cuts against Fed policy as it is, right? Like meaning they want to be data dependent. They do not want to be trying to anticipate, right? I mean, like, and if you were going to cut right now, I'm just trying to walk through it I'm not saying this is the way that I view it, but trying to think about the way they think about it. If you're going to cut right now, I don't really see any impetus at this moment. So it has to be a prophylactic cut, for lack of a better term. I mean, a preemptive cut.
I think that's true for sure. I think they would say, look, if you look at how the labor market has evolved over the last 3 months, say where we thought it was 3 months ago to compared to where it is now, is way worse than we thought it was. Revisions and stuff, and it's worse than we thought it would be looking forward from here. So I think
Yeah.
that's the case they make. But to be clear, like they might be wrong. Like we've talked about, the net immigration is so low that low hiring numbers may be totally normal.
Well, they might be wrong. The other side of it too is they're looking at the same data we are.
Yeah.
Like
you can splice it and dice it however you want. Like you really people take that whole like statistics lie thing too far sometimes, but right now like you really can paint a picture both ways. I've never been in a situation where like I felt strong about something, because I do right now. I feel strong inflation's a big risk and they're sleeping on it. But like someone on the other side of me, like I totally respect the argument to be like, look, the labor market might fall apart here. And I'm like, it might, you're right. So it's tough. But we also get their economic projections because they only do those quarterly. And I think it's worth like talking about where they had everything this last time. So they had growth. This is for the whole year. So like where you exit 2025.
Mm-hmm.
So a quarter ago, they had growth at 1.4. I think they have to revise that up. The unemployment rate at 4.5. We're at 4.3 right now. They might have to revise that up, but they also might not. They had inflation at 3, core inflation at 3.1. They have to revise those up. They'd be crazy not to. And they had the Fed funds rate being at 3.9. So I think the revisions we're going to get tomorrow are just going to reek of stagflation, because they're going to be like, ooh, yeah, we think actually, unemployment's going to be worse, but hey, growth's fine, and inflation is higher than we thought.
Yeah, another thing, we've probably talked about this before, but another thing I was thinking about, my daughter was talking to me about her friend just getting a job, same age as her, and working at a fast food joint, making $18 an hour, right? That's another thing that we got to think about. When you look, I don't think we've ever had a period of time where minimum wages across the country went up more over such a short period of time, right? That's throwing a lot of weird stuff into the economy too, right? When a kid goes out and gets a job in Washington State, he's not making less than $16 an hour.
Right. And it's, a lot of coastal areas, high income areas have pretty big minimum wages.
Yeah. And when you see what's going on the immigration front, and then you look at what's going on minimum wage front, that's just, that is very inflationary / stagflationary.
Yeah. And speaking of
and why is it stagflationary? Think about the increase in labor costs. If you do not think that that's going to give it, let's say you're a company, right? Let's say you and I own a fast food restaurant, and we've got this distribution plan, right? We're going to grow across the country. In states where you've doubled the minimum wage in the last 5 years, that's going to have some impact or some slowing effect on how you spread out, right? Where you push out. And maybe certainly not with every company, right? There'll be one-offs,
right.
But on balance, that in itself is very stagflationary, right? It's a depressant on the economy, yet it is a much higher cost that business has to internalize and therefore pass on to consumers.
Right, and that's why between labor costs and some of the reshoring and the tariff stuff, like you're getting a lot more automation. Like the people are leaning into that stuff more than I think people realize, which is kind of good and kind of bad. It just depends on how it shakes out. But just from a personal standpoint, like we went to Costco this past weekend. Inflation is not a joke right now. It is.
No,
it was. I could not believe how much that like basket of goods costs. Like it has. I know the stated inflation is 3% right now, and I'm fine with numbers. Like I'm not one of these like, oh, it's 20%, not 3 or whatever. But it has inflected inside of 2025 to me, and clearly that has not been captured by really anybody's data capture yet. But I was kind of stunned by how much that basket of goods cost.
I continue to be amazed by the elasticity of the consumer. I mean, we're saying things are slowing, but I just
retail sales number was great today.
Yeah, and I'm looking.
Granted, that has inflation in it, but
no, but I look at these. Families. 2 parents, 3 kids. Mom stays at home, dad works. Dad's making let's say 150, 250 grand. And I'm looking at the cost of all this stuff. I'm sitting there. I don't know how these people. I don't know how they're. I don't get it.
Right.
I just don't get it.
It's like when we went to Disney last year. I'm like,
oh,
I make good money and that stung.
Oh, dude, yeah. You don't make Disney money.
Yeah, I don't think anyone makes Disney
no,
money.
Disney makes Disney money. I mean, that's that place was just a hose job.
And you go to Costco to save money. And
Yeah.
Costco's gotten busier, so like there are some people taking saving money more seriously. But yeah, I don't know. It wasn't 3% inflation on the Costco bill. That's all I'll say.
No. And then, then you think about people in Washington. On top of all this stuff in this state, you're also paying about double the price for gas that everybody else in the nation is paying for because of the taxation policy here.
Right.
I was talking about that. That one cracks. The evil, greedy oil companies. You're like, okay, what happens to that narrative when the state is making more per barrel of oil sold than they are? Right? Like, hey, there goes one of your favorite narratives that just went up in smoke. You mean the big, greedy state government?
Yeah.
That's crazy. We're like at 100%, and we might be slightly above that in taxes. There's multiple taxes here in the state, but because what is the average cost of gasoline right now across the country is like 210, 220, something like that, and it's like 450 to 5 here in the state of Washington. It's just brutal.
I mean, yeah, oil $60 something, and it feels like if you were in Texas, it would feel like it's $95 oil right now.
Yeah,
for sure.
Yeah, it's wild times, man. Anything else to add? I'm trying to think. No more crazy, no crazy earnings. Nothing
kind of quiet earnings season right now.
Yeah. Oh
no, it's gonna be an interesting day tomorrow. I think we do run the risk of buy the rumor, sell the news on Fed Day. But hey, we just talked about you can go anywhere from like the range of possibilities tomorrow is bigger than normal. So who knows what happens.
If I was not having a good year and I was underperforming, I would probably be a little overexposed right now, hoping to pick up some.
And I'm sure everyone is. Right?
Yeah. The flip side is if you're having a good year and if you've outperformed, I really don't like the next 2 to 3 weeks. And it feels like one of those times where prudence is the best course. If that means you make a little less to the upside, so be it. My biggest thing is sitting there looking at it and going, I just don't want to give, up almost 30% in the year. I just don't want to give a bunch back.
100%.
And it kind of feels like you're going to get some volatility. Now that I've said that, you should probably go levered long the Qs.
They'll just cut 50 and say they're going to do it again next month, and we'll be up 3% tomorrow. And
okay, you and I both know they won't do that, right? No, I like Dave, and this is a conversation for another day. But the Fed has gotten so into the market knowing exactly what they're going to do. And I think that's a mistake. I've said that for a really long time. I think that encourages excess risk taking. I think that encourages excess leverage. And I think that I understand why they do it. I think that it is engendering the opposite impact that because they do that because they think it engenders market stability, right? I think eventually it creates the exact opposite.
Yeah, well, we know what Minsky said, stability breeds instability. So
yep. That's kind of unavoidable. Isn't it amazing how just we for whatever reason like to forget historical lessons that we've had to learn over and over and over?
It is the story of humanity.
I know. Jeez. Anyway,
speaking of great book, The Lessons of History. That's basically all the book's about.
That's in your office right now, isn't it?
Probably.
I got to borrow that one from you. Anyway, all right, you guys know the deal. As always, follow us on YouTube, Twitter, video on YouTube, search Know Your Risk Podcast. Go to knowyourriskpodcast.com, bulwarkcapitalmanagement.com. Not hard to find. Anyway, have a wonderful evening. As always, we'll be back tomorrow. We'll see you then. If you're listening to the Know Your Risk Podcast, download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.